Welcome to this explainer. Today, we're diving headfirst into a topic that keeps CFOs up at night: how global companies manage the incredibly high stakes of national and state tax calculations using SAP S/4HANA. If you've ever wondered how multinational corporations avoid catastrophic compliance failures across borders with constantly shifting regulations, you're absolutely in the right place.
We're going on a journey from macro to micro today. We'll briefly cover the global tax challenge, break down the tax calculation procedure, demystify those tricky tax codes, look at managing tax postings, and wrap up with tax account configuration. Let's get right into it.
Part 1. The Global Tax Challenge.
Okay, we have to start with the sheer massive scale of this headache. Just in the United States alone, there are over 67,000 possible tax jurisdictions. Seriously, take a second to let that sink in. Over 67,000. When you're dealing with taxes levied at a state, county, or even city level, doing this manually or even with just basic accounting tools is, well, literally impossible. It's a compliance nightmare. And that's exactly why SAP S/4HANA uses a generic interface software to connect with third-party systems. It's the only way to figure out the right tax allocations for every single one of those unique jurisdictions.
And you see this stark divide everywhere you do business globally. On one hand, you've got countries with nice, uniformly defined rates at the national level. Super simple, right? But then on the other hand, you have countries that layer on highly variable state or jurisdictional taxes. In places like the US, Canada, India, and Brazil, they're actually hitting you with taxes on multiple levels at the exact same time. US sales and use taxes are a textbook example of this below the national level complexity. Your system's calculation procedures just have to be able to handle both extremes without breaking a sweat.
Moving on to Part 2, the tax calculation procedure.
So how do we actually solve this? Well, SAP acts like a giant built-in tax engine. But before that engine cranks out a single calculation, national regulations tell us where we have to start: the base amount. Think of this as your core expense or revenue. You have to define it as either a net amount, which means the taxable item excluding any cash discounts, or a gross amount, which includes those discounts. And you set this rule either for each individual company code or at the very top level of the jurisdictional code.
All right, once you've got your base amount, S/4HANA kicks in with a pre-configured calculation procedure that's specific to every single country. I like to think of this as the system asking three basic questions: when, what, and where. First, the sequence of steps tells the system exactly when to call that base value. Next, the tax types, also known as condition types, pinpoint exactly what specific taxes actually apply to that country. And finally, the account key determines where the money goes by routing it automatically. SAP actually hands you predefined account keys right out of the box, and standard practice says you absolutely want to use them.
Now you might be wondering, how does a real human being sitting at a desk connect a totally standard, everyday invoice to this massive automated engine we just talked about?
That brings us to Part 3, demystifying tax codes.
The answer is tax codes. They are the essential bridge connecting your standard accounting documents directly to that complex jurisdictional calculation procedure. You see, you assign specific tax rates straight into the tax code itself, and then those map right back to the tax types we just looked at. And these codes, they are incredibly flexible. Say you have a tricky 10% tax that needs to be split, maybe a 6% input tax and a 4% non-deductible tax. No problem. The tax code handles the whole shebang. All that data gets wrapped up in the code, which is then linked to either a country key or a combo of a country key plus a tax jurisdiction code.
But wait, what if the transaction is tax exempt? Do you just skip it? Actually, scratch that. No. You still have to apply a special tax code, just with a zero rate. Because even if you owe absolutely nothing, the tax authorities definitely still want a record of it. This goes for items that are tax exempt but legally require reporting, and also for things created by tax exempt transactions, like when you're issuing or moving goods. If you don't assign that zero rate tax code, your compliance reporting is going to have holes in it, and you will definitely run into trouble.
All right, Section 4, Managing Tax Postings.
So the math is done. What happens next? The software seamlessly takes over the heavy lifting behind the scenes to automate the postings, which is a total lifesaver for reducing human error. It usually does this in one of two ways. The standard, everyday way is that calculated taxes automatically post as a separate line item directly into a special tax account. But sometimes, depending on specific transaction keys, like key NVV for example, the tax gets distributed straight to the relevant expense or revenue line items instead. You'll see this distributed method happen a lot with sales tax payables or non-deductible input taxes.
Now, to make this automatic account determination actually work, you've got to give the system its marching orders, right? You need to set the rules. First, the system obviously needs to know which specific tax accounts to target. Then it needs posting keys. And pro tip here, the standard recommendation is to stick with keys 40 and 50. And finally, it relies on rules that look at fields like the tax code or the account key to figure out exactly how the whole account determination should play out.
Which brings us to our final stop, Section 5, Tax Account Configuration.
When you're configuring the individual general ledger accounts, the tax category field is basically your ultimate cheat sheet. You pop a symbol in there and it dictates exactly what kind of tax code is allowed. Leave it blank, that means it's for non-tax relevant stuff, like a bank posting. Put in a minus sign, and it means the posting requires an input tax code. Think payables. A plus sign? That requires an output tax code, which is perfect for receivables. An asterisk just means any tax code is fine. And if you use XX, well, you're restricting it to postings with that one specific predefined tax code XX.
Of course, there are always edge cases, but the system has some great built-in shortcuts. Let's say you're dealing with a foreign customer who just doesn't have a jurisdiction code. All you do is select the Postings Without Tax Allowed option. This lets you cleanly bypass the strict tax code requirement on those GL accounts, which is an absolute must-have feature, since those calculation procedures are usually tied to jurisdiction codes. Oh, and for your dedicated tax accounts, you'll want to use the less than symbol specifically to define input tax accounts in that tax category field.
We've covered a lot of ground today, navigating the absolute massive scale of the global tax challenge. I mean, we're talking over 67,000 jurisdictions in the US alone, not to mention the complexities of layered national and state taxes, figuring out base calculations, and setting up highly specific rules for your GL accounts. So as you look at your own global enterprise landscape, consider this. With global tax laws shifting constantly, is your underlying SAP configuration truly resilient enough to keep you compliant tomorrow? Thanks for joining me on this explainer, and I'll catch you next time.